Here's 3 expenses you cannot claim on your self-assessment tax return as a buy-to-let landlord. Number 1 is mortgage payments. It's long been the case that capital repayments are not an allowable expense for landlords, but it was only more recently in 2017 that HMRC decided that mortgage interest and other financing costs would also need to be disallowed when calculating rental profits for a buy-to-let landlord. The landlord will still benefit from some tax relief in the form of a tax reducer, but in many cases this will be less generous than the pre-2017 rules. Number 2, property improvements. Now there's an important distinction here because repairs and renewals, which might include replacing a shower, retiling or decorating, anything where you're replacing like for like, these are allowable expenses. But an improvement, which might include adding an ensuite, building an extension, or even a loft conversion, would all be disallowed when calculating rental profits. These items are considered capital in nature and would form part of your capital gains calculation when you dispose of the property. And number 3, replacement furnishings and equipment. This one applies where you let a part or fully furnished property, because technically you cannot claim for replacing beds, carpets, sofas and general furnishings. Again, these items should be disallowed. However, you will usually qualify for something known as replacement domestic items relief, which should be equal to the expense of replacing the item, providing a similar quality product was purchased. Where the item has been upgraded to something superior, the relief will be restricted to the value of replacing the item like for like.